Welcome back to All About Economics. Have you ever stopped to wonder how an entire country keeps track of every single dollar, euro, or yen that crosses its borders? Not its own budget, but its complete financial relationship with the rest of the world, from a massive shipment of cars, to a foreign company buying a local startup, to the aid one government sends another. It sounds impossibly complex, yet there is one powerful accounting tool that captures all of it: the balance of payments. In this episode, we open the books on a nation's global finances. You will learn the fundamental rule of credits and debits, the two great accounts that sort every transaction, and the remarkable fact that the whole thing must always balance to zero. Let us build it from the ground up. Section 1. The National Diary. Think of the balance of payments as a country's annual financial statement, but for its dealings with the entire world. It is a national ledger that records every transaction involving foreign currency crossing the border, every car imported, every tourist swiping a credit card, every investor buying a local company, every interest payment sent abroad. All of it gets logged. It is, in a sense, a massive national financial diary, and learning to read it is the key to understanding a country's financial health and its relationship with everyone else. Economists and governments around the world use this single framework, which is what makes it so powerful. Master its logic, and the entire international side of an economy snaps into focus. Section 2. Credits and debits. Here is the single most important rule, and everything else builds on it. The balance of payments uses simple double-entry logic: credits and debits. If foreign money comes into your country, that is a credit, money in. When a foreigner buys your exports, or invests in your companies, or sends you aid, money flows in, and you record a credit. If your money goes out to pay for something foreign, that is a debit, money out. When you import a car, travel abroad, or buy a foreign stock, money flows out, and you record a debit. That is the whole grammar of the system. Every single international transaction is, at its heart, either money coming in or money going out, a credit or a debit. Section 3. The current account. Now we sort those transactions into two great buckets, and the first is the current account. The current account records the flow of goods, services, and income. Its biggest piece is the trade balance, the value of the goods and services a country exports minus what it imports. But the current account is broader than just trade. It also includes income, like the dividends and interest a country earns on its foreign investments, minus what it pays out to foreign investors. And it includes current transfers, such as foreign aid and the remittances that workers send home to their families. In short, the current account measures whether a country is, on net, earning more from the world than it spends, or spending more than it earns. Section 4. Surplus and deficit. This leads to two words you hear constantly in the news. When a country exports more than it imports, when money coming in on the current account exceeds money going out, it runs a current account surplus. It is, in effect, earning more from the world than it spends, and lending the difference abroad. When a country imports more than it exports, it runs a current account deficit, spending more on the world than it earns, and it must finance that gap somehow. Neither is automatically good or bad. A fast-growing young economy may sensibly run deficits as it imports machinery to build for the future, while a mature economy may run surpluses. What matters is not the label, but the story behind it. Section 5. The financial account. So how does a country finance a current account deficit? Or what does it do with a surplus? That brings us to the second great bucket, the financial account. While the current account tracks goods, services, and income, the financial account tracks transactions and assets, the buying and selling of ownership across borders. When foreigners buy a country's government bonds, its company shares, its real estate, or build a factory within it, capital flows in. When a country's own residents buy foreign assets, capital flows out. This is the account that does the financing. A country running a current account deficit, spending more than it earns, must be pulling in capital from abroad to cover the gap, selling assets or borrowing, which shows up as a surplus on the financial account. Section 6. Why it always balances. Now the beautiful part, the reason it is called the balance of payments. Taken as a whole, the balance of payments always sums to zero. This is not luck or policy. It is the iron logic of double-entry accounting. If a country buys more from the world than it sells, the difference does not vanish. It must be paid for, either by borrowing from foreigners, by selling them assets, or by running down the country's reserves. Each of those is a financial account entry that exactly offsets the current account gap. So a current account deficit is always mirrored by a financial account surplus, and the grand total comes to zero. When you hear a country has a balance of payments deficit, what is really meant is a deficit in one account, offset somewhere else. The total always balances. Section 7. Reading a nation's health. Because the total is always zero, the skill is not in the sum, but in reading the composition. The balance of payments is a diagnostic tool. A country financing a trade deficit by attracting long-term foreign investment into productive factories is in a very different, healthier position than one financing the same deficit by piling up short-term debt that could flee at the first sign of trouble. Persistent, large current account deficits funded by volatile borrowing have been the warning sign before many a financial crisis. So economists pore over the structure of the balance of payments, asking not just whether money is flowing in or out, but through which channels and how stable those channels are. It is a window into a nation's economic vulnerabilities and strengths, and read well, it can reveal a brewing crisis long before it actually arrives. Section 8. Tying it all together. Finally, see how the balance of payments stitches this whole course together. Remember the saving investment identity, that a country saving more than it invests sends the surplus abroad. That surplus is precisely a current account surplus and a capital outflow, the very same idea, viewed through the balance of payments. And remember exchange rates, set by the supply of and demand for a currency. Those flows of currency are exactly the credits and debits we have been logging. So the balance of payments and the exchange rate are two views of the same underlying reality. The balance of payments is not an isolated topic. It is the accounting backbone that connects a nation's saving, its investment, its currency, and its place in the global economy. Conclusion. We have opened a nation's global books. The balance of payments is the ledger of every transaction with the world, built on the simple rule of credits in and debits out, and sorted into the current account, which tracks trade, income, and transfers, and the financial account, which tracks cross-border assets. The two always mirror each other, so the whole sums to zero, which means the real skill is reading the composition to judge a country's health. And it ties directly back to saving, investment, and exchange rates, the accounting backbone of international economics. It is, in the end, the scoreboard of a nation's entire economic life with the outside world. This brings Part A's theory to a close, and next we apply everything to a single dramatic real economy, in the story of Israel's battle with hyperinflation and its road to stability. If this made the global books make sense, please subscribe to All About Economics and share it. See you there.